Hey traders, this is Austin. Why don't we do a couple of videos that I've done in the past as far as public webinars for our distribution list only here that detail how we stay on the correct side of price action. In other words, do you always want to be looking to the long side when price is or about to be going up? Do you want to be on the sell side when price is or about to be going down? We do, and this is how we do it. But let me preface first with a little, some psychology, if you will. Actually, some realities of the market. I hear from a lot of traders things. They'll ask questions like, is your information black and white, systematic? In other words, does it tell me exactly where to buy, when to sell, when to go get a drink, so on and so forth? And my answer to that is always no. That stuff doesn't work. If you're a trader or you're an aspiring trader who actually thinks somewhere out there, an individual who's not running $100 million HFT algo somewhere has a system that will tell you where you can get in, where you can get out to the exact tick for whatever market or symbol, and that it's for sale or available to the masses so that hundreds or even thousands of people could purchase that and put it to work and try to clear thousands or tens of thousands of futures contracts or shares of stocks in the exact same manner in and out. If you think that actually exists, trading's not for you. I respectfully but strongly suggest if you have money in a trading account, take it out of there now. Close your account and save your money, because whatever your balance is at this moment in time, that's the peak that it's ever going to be. If you think that there is a black and white mindless system available to an individual at home retail trader that will tell you everything you need to do and make money, you've failed already. You have no hope. All right, so please get out of the industry. Don't read another blog. Hit delete to this video and email or whatever the case may be, and forget about financial markets, because that simply doesn't exist. If it ever did in the past, it certainly does not now, the way markets are completely high frequency traded, algo dominated. All right, but on the other hand, if you're open to being a thinking trader, if you understand that the edge in your trading exists in your mind and your decisions, and you are responsible for your results, whatever they are, okay, then you have a chance to win. You have a chance to prosper and prevail. Trading is not easy. It's hard as hell. It's never been easy, and it's certainly not easy today, and it won't be easy in the future. Right? It's simple, maybe, yes, but not easy. There's a lot to it. You need to think, you need to act, you need to make decisions, you need to take responsibility for your decisions, and you need to accept the outcome and change that outcome going forwards with new decisions. That's the essence of trading. If you can do that, then party on. Okay, and join me with the discussion we're going to have. If you cannot do that, if you cannot be self-directed, if you cannot make correct decisions for yourself, if you're thinking, hoping, praying that somewhere out there you can find a mindless system that just shows you, red and green arrows and you buy and sell and everything's happy, please delete this info now and get out of the markets and save your money and all of your pain. I don't do this here trying to recruit as many people as possible to purchase my services. I do this looking for people who are serious about trading, who are willing to do what it takes to win, willing to pay the price to create success for themselves. If that's you, let's roll. There are 3 tools, 2 primary and 1 secondary tool that I use to stay on the correct side of market direction every day, and very seldom am I fooled on direction, if there is one. Now, there's no cure for sideways chop, because how could there be? Nothing happens. We have tools that help us stay out of the majority of chop, all right, and so we have that in place, but obviously you can't be on the correct side of market direction when there is none. And the other thing that you can't be is on the correct side of market action when it's explosive. Now, this was the most recent session. This was Friday, November 4th, okay, and this is crude oil, and it was trending lower, and then something came out, the usual inane news that the rumors or whatever that the market deals with hundreds of times a year. hundreds of times a year, somebody will come out in the crude oil market and say something like, Saudis are restricting output, Venezuela's restricting output, somebody's going against OPEC, blah blah blah, and the algos, the HFT algos will skim the headlines constantly, will read that and react, and they kick off a domino effect, and it will last fractions of a minute or a minute or two, and then the people at the controls realize that the algos got fooled and they blew out the market, and then it adjusts to whatever it does. Okay, so that's the difference between now and times in the past. The liquidity of the markets and the major market players are such that when things happen directionally, it's often explosive. So obviously, that's not a move that you can easily participate in. How can you when it moves 100 ticks in a fraction of a minute? Sometimes within fractions of a second, it will take off 30, 40, 50 pips. How can you can't when that's an entire day's range in the blink of an eye. But during normal, methodical, trending or reversing market action, oscillating, I guess you could say, we're always on the correct side. And here's one of those three tools that I use. Now this one, the CM-RoadMap, is based on the open range of a pit session of trading, okay? So it's not applicable outside of the pit session of trading. It is in some degrees after the pit session. For example, tomorrow is Monday, November 7th, and if we're trading the pit session and we apply this price measurement tool to it, and then the pit session closes, the post-market Globex to follow will respect these levels, okay? But it's not something that if we want to trade Monday that we can apply a new study to it in the pre-market, and that'll be effective. So this is primarily a pit session of trading tool, although it does have a little bit of functionality afterwards. It's based on pure price action. It's totally generic to any system or methodology you may have that allows you to make trade entry decisions and so on and so forth. There's absolutely no conflict in this study to anybody's anything is the point I'm trying to make. And of course, it's completely complementary to what we do here as far as selecting our trades. I will say this before we get started. I do not use this in any way, shape, or form to seek trade entries. Okay, so let me repeat myself. There are no trade entries involved with this approach. There are no stop settings involved with this approach. It has nothing to do with selecting a place to get in a trade. It has everything to do with which way to trade, which is critically important. And there's strong statistical probabilities involved here, probabilities that a Vegas gambler would kill for. And if we put those probabilities to work in our favor, we can make a killing in the markets too. All right, so the first 5 minutes of an open range are generally decisive to what the rest of the day will hold, and it will tell you which way the market is likely to go from certain locations to other locations, and it will tell you when price action is changing direction. It'll tell you when the day is trendless. It'll tell you a lot of things if you pay attention, and this is applicable to any market or symbol with a pit session of trading. There are no exceptions. Sometimes the 10-minute time frame is more applicable than the 5-minute time frame, and the usual instance there is in the first 5 minutes absolutely nothing happens. In whatever market it is, it's just a very dead flat tiny range for whatever reason in the first 5 minutes, and so then after that the next 5 minutes, or a total of 10, is really what sets the tone for the day. I happen to believe that this discovery of mine, this isn't something I created, and it's not something I invented. This is something I discovered, and that means it already existed, and it's existed since the beginning of time. I've looked back through charts in the 80s and 90s where this is every bit as applicable then, was every bit as applicable then as it is now, and it will be going forward. Right? It's the rhythm of the market. Think of it as the profile of intraday markets. All right? That's probably a good way to say it. It supersedes everything else. And it goes like this. The first 5 minutes of the open range dictate a lot about what, it tells us a lot about what price is going to do, and it dictates a lot of things. First of all, if price is at or below the bottom of the open range, that is highly bearish. And any time price pulls back to that, it is highly bearish. It doesn't matter what price has done from the first time it broke. If it proceeds lower, broke the bottom, any time and every time it pulls back to the bottom of the open range, that's a very bearish zone. And if you get sell signals there, or I should say if you search for sell signals there and find them, whatever the case may be, they have a high odds probability of succeeding. By the same token, price action at or above the top of the open range when price action is here is very bullish. And it doesn't matter if price has taken off to the upside once or twice and failed. Each time that it pulls back to the top of the open range is a bullish instance. If you find or search for buy signals in that zone and take them, you're going to have a high degree of probable success. Okay? Now, the other thing the market will do off the open range is it will go to predefined measures of price. And it does this with such uncanny accuracy, it will amaze you. It'll simply amaze you if you study this over time. I've seen this unfold for so many years across all of the symbols that I track and trade that it doesn't surprise me anymore. Long ago, I stopped being amazed and started being expectant. When I see price doing whatever it's doing, trading up or down, I fully expect it to go to these statistically probable levels, and more often than not it does. And here's the statistics, all right, giving you the levels. This is just a basic Fibonacci retracement grid used, and I happen to use NinjaTrader charts, and it's an F8 command. And the levels I have set up, of course, are 0 and 100 that show me the top and bottom of the open range, and we'll talk about how that's applied. And then the levels that I use happen to be 233 to the positive, 382 to the positive, 512 to the positive, and then those same values to the negative. All right, and then there is a use for the 50% zone here too. Now, one of these sides happens to be a deep pullback, and one of these sides happens to be a Fibonacci extension. In other words, one of them's a deep retracement, which also involves the open range if you want to be technical, and then one of these is a Fibonacci extension of itself. I didn't invent these numbers. These aren't something that I had constructed and then, the market conforms. This is just what the market does. And I played around with different levels and different values, and a range of them work. You can apply 250, 333, and 500, and 750, and you're going to find a strong correlation of price to those. And so, in other words, that would be in this zone. So here's 233, and 250 would probably be here somewhere, and you can see how price responds to both. I happen to find this to be, just in my opinion, a little bit more respected by the market, and so that's why I use these. And I think the market respects these fib numbers a little bit more because fib is so highly ingrained in the trading world. I happen to think that these levels are a self-fulfilling prophecy. I happen to think that the machines that make the markets have an expectation that if price does something, it's going to expand to somewhere else. I happen to think that these levels incorporate strong or higher volume locations from sessions past where there is a thickness of support and resistance. Okay, and I think that that whole process of mathematics marries itself to create this self-fulfilling prophecy. When Monday, November 7th comes along, that would be tomorrow, and crude oil opens up and all the other markets open up, if you apply the study then, the same exact thing is going to happen in front of your eyes into the future that happens every day. All right? So there's no curve fitting here. There's no looking back, and there's no hindsight or any of that nonsense. This is a forward projecting price model that every single person, with zero exceptions, can apply and use at the exact same moment in time. Isn't that a beautiful thing? Every crude oil trader on the face of the earth, including myself, tomorrow on Monday the 7th, November, can apply this at 9:35 a.m. Eastern Time, and we all see the exact same information. And guess what? It does the exact same thing for all of us, right in front of us, through time, going forward. That's powerful. Here are the statistical probabilities of these things happening. The values of 233 are 90+% statistically probable to be hit on any given day. On any given day, price is going to go from the first 5 minutes of the pit session to the 233 zone above or below, or both. Many days it will visit one, and then it will change course and it will visit the other, and then do whatever it does, be contained within those two, hit the first one, turn early, and then go the opposite direction, so on and so forth. But purely speaking, you have a 90% probability of any market or symbol hitting one or both of these values inside of the pit session. That's an incredible odds of probability, and that's why on a day like this I would be aggressively short here. I would be shorting the hell out of this, quite frankly, until price did at least that. And then from there, when price is below that value, I would be shorting whatever other sell signals come, expecting it to do this or that. Because the expectations here are for 62% probable. In other words, and of course it's an inverse of itself. The 382 is about 65% probable to be hit on any given day. So in other words, 6 days out of 10, or roughly 3 out of 5, a little bit more than 3 out of 5, price will trade to one or the other of the 382 values. That's incredible. And guess what? The 512 zone, that's 50% probable. 1 out of 2 sessions on average will hit that. That doesn't mean every other day, and there's not necessarily an expectation. Let's say 2 days are very congestive and price doesn't hit the 500 zone. That doesn't mean that there's any greater odds of probability the third day. This is a random coin toss on any given day of where price is going to go that resets itself. There's no strong correlation to what did or did not happen a day or 2 or 3 before. Even though gamblers like to think that there are expectations based on past results. In other words, if you flip a quarter 5 times and it comes up heads or tails all 5 times, then a gambler will think, wow, I had to double down my bankroll because it's only a matter of time before tails comes up. Well, that's true. Tails may come up the 6th time or the 60th time. You never know. And so you can't bet your bankroll too big because there's no correlation from one coin toss to the next. The only correlation there is when you take 100 coin tosses of this sequence and then another 100, then another 100, then another 100, you're going to find that they give you something to work with. But just because price did or did not do something for the last day or 2 or 6, it doesn't mean that it's going to do anything for sure or more likely today. All right? If you understand statistics, then that's simple math. That's simple concept to you. If you don't understand statistics, I strongly suggest you study those. All right? But on this given day, if price, I'm looking to sell this all the way. I'm not looking for buy signals here at all. Period. I'm expecting a trend unless it shows me otherwise. The most recent section, I probably misspoke earlier. Here's the most recent session. This is the 4th prior to tomorrow. So here's the open range, and this was a Friday, and Fridays tend to do squirrely things. This is the open range, and I'm looking to short, well, anywhere here, quite frankly, below the 50% of inside of the open range. I'm looking for sell signals here or wherever they occur to there. Okay, and I happen to be short from somewheres to somewhere else, and it was a successful day, and that was that. And I closed the short position somewhere near the low, relatively near the low, and just before whatever news broke about OPEC production, oil related nonsense, blah blah blah. And you can see the price failed to reach the 233 objective down here. Like I said, it's not written in stone that it's going to hit either of them just because it's headed there, but it will hit one or the other or both 90% of the time. What happened? News came out and they blew it up, and what did they do? They went right to this 233. They fulfilled that, and then they turned over, and then they came back inside the open range. You can see where they tested and held, and then they tested and held to 50, and then they dribbled lower, and that was the day. Do you see the strong correlation of all of this, which is not hindsight? Okay, this was constructed, this was applied, I should say. This was applied at 9:35 a.m. on Friday morning. Every single crude oil trader with zero exceptions could have done this and would have seen the exact same thing, and they would see this is very bullish, this is very bearish, short here, that works, blam, that's an explosion no one can see. They pull back, this is bullish, okay, from 44.40 up to the 80-90 zone. This is bullish. You can see where they pulled back and then they popped a little bit more, and then you can see where they rolled over and they faded down and so on. That's the general gist of it. If you're looking sell side here all of the time, and you're looking buy side here all of the time, and you're looking sell side here all of the time, you will always be on the proper side of methodical price movement. You cannot be on the correct side of explosive market movement for obvious reasons, but you can be on the correct side of methodical all the time. Here's the S&P on that same Friday, and there's the grid, and they chopped inside the open range, and then they traded outside the open range. And remember, we're strongly bullish here, and what happens? They go up and fulfill the 233% like they do 90% of the time. Here was a small range on Thursday, and you can see the price stayed within that range until it didn't. All right, they held inside the range until they broke down, and then they traded to the 233 and a little bit below later in the day. If we say that's a very narrow range, which it was, let's have a look at the 10-minute open range as well. Same situation. Now they hold cleanly inside of the zone. They break down. Here's the sell zone that worked at midday, 12:30 or whatever. They traded to 233 and so on. Statistical odds of probability are extremely high, huge actually. 90+%, 60+%, 50% that any gambler in Vegas would die for. Like I said, open range. It's rather small. It's a 3-point open range or so on a rather squirrely day. They trade up to the 233. They come back through. They chop their way down. They trade to this 233. This is an FOMC day, of course, and that's all the reactions that go on and so on. Even though the market is highly buffeted, if you will, through whatever went on during this session, it still respects the technical levels highly. Okay? Strong correlations here. Absolute ironclad statistical probabilities. Something that you can expect and you can count on tomorrow and the next day and the next day and the next day. And it's very simple math. I'll recap that. The values that I use in the grid, of course, 0 and 100. 2, 3, 3, 3, 2, 5, 10, 5, 12, and then the reverse. And the way I draw these grids, if you haven't picked up on that by now, here it is exactly. If it is a red or a down close, then I will start my grid at the top and I will end it at the bottom. In other words, I go with the direction of trend of the first 5 minutes. And the 5-minute trend was down for the open of that session. The 10-minute trend overall was up for this one. You can see that it opened where it did and it closed where it did. It opened here, traded lower, closed there. That was a bullish trend to the open range, and so that's how I apply that grid. It's very simple. This was a bearish start, but it happens to be a what's called spider doji, if you will, or a somewhat neutral bar, and it gives the same effect that price trades from the open range up to the 233. I will at times run them both ways, and I'll say, okay, is there some confluence zones here that I need to look at? And a lot of times price will trade when there is an indecisive open, price will trade to the confluence zones strongly. It did not in this case. Okay, it traded to this expression, the bearish expression, and that would be the first one that I would use because candles red, you draw down, they traded to there, and then they rolled over, and that's that. If you put this to use for yourself, and I can tell you for an absolute fact that if you apply this tomorrow and it's the first time you ever did, you won't think much of it. because what I tell you holds very little merit. I'm just somebody who suggests that something works. You need to see it for yourself. We're all from Missouri, especially traders. Traders are so jaded because they hear so much and they read so much, and 98% of it is just crap, to be honest with you. And there's very little out there that really matters in trading. But what really matters. This is one of those. If you apply this tomorrow and the next day and the next day and the next week and the next month, and you do it over time, by the start of next year, after you've watched this for a couple of months, you'll be a strong believer. And by the start of 2018, if you've applied this through all of 2017, not only will you be a believer, you'll expect. I mean, it'll be just second nature. Like, okay, pit session's open. Let's apply the grid. Here's our levels. There we go. This is likely to happen today. Da da da. Okay, price is trading above or below. I want to be long or short, and I don't think anything more of it. In other words, you're not second guessing yourself. This takes second guessing away. When you add confidence to something and you add clarity, then you also instill discipline, and that's a critical component. There's a lot more to this study. We could go on and talk about it, indefinitely or for much longer periods of time. And we do that inside of the educational part of our program, obviously. This is just a precursor or an overview, enough information to arm you to be successful, to apply it, profitably in your case, and to give you a strong idea of what exactly we do for our fellow traders and clients. Hope this helps. Look forward to seeing you in the next segment. And as always, best trading wishes.